In January of 1913, an American factory worker in Pittsburgh received his weekly wages in cash. He walked home with every dollar he had earned. No federal deduction, no withholding line on any stub, no government calculation sitting between his labor and his family's dinner table. What he earned, he kept, all of it. By December of that same year, the legal architecture that would eventually take a portion of that same paycheck, before he ever touched it, had been signed into law, debated, shaped, and delivered by the very men who stood to benefit most from the structure it created. This is not a story about taxation. Taxes have existed since civilization began. This is a story about a specific transformation, about how a country that had funded itself for 41 consecutive years without taxing personal income decided, in a single 12-month window, to change that arrangement permanently, about the men who designed the new system, about what they promised it would be, and about what it actually became. Because there is a version of this story you have been told, a progressive reform, a fair contribution from the wealthy, a modernizing of antiquated revenue structures, that version is not entirely wrong, but it is not the whole story either. And the part that gets left out is the part that should disturb you most. To understand what changed in 1913, you have to understand what existed before it. From 1872 until 1913, the United States federal government operated without an income tax on individuals. That is not a brief gap or a rounding error. That is 41 years, a full generation, 2 generations in some families. During that period, the federal government funded its operations almost entirely through tariffs on imported goods and excise taxes on alcohol and tobacco. According to records kept by the IRS itself, from 1868 through 1913, approximately 90% of all federal revenue came from taxes on liquor, beer, wine, and tobacco. The system worked. Roads were built. Wars were fought. The country expanded across a continent. And not once did a federal agent calculate what percentage of your wages belonged to Washington before you saw them. There had been a brief income tax during the Civil War, imposed in 1861 and repealed in 1872. There had been another attempt in 1894, when Congress passed an income tax that the Supreme Court struck down the following year in Pollock v. Farmers Loan and Trust Company. The court ruled it unconstitutional because it was a direct tax not apportioned by state population, as the Constitution required. That ruling stood for 18 years. The Constitution, as written, blocked it. So the question is not whether someone wanted an income tax. Clearly, people did. The question is who wanted it, what they needed it for, and what they built around it once they got it. The story begins in earnest in 1907, though the men who matter most were already in position long before that. In October of 1907, a financial panic ripped through the American banking system. Credit froze, banks across the country failed, the stock market dropped so sharply that institutions that had stood for decades collapsed within days, and the federal government stood by, essentially powerless, because it had no mechanism to intervene in a banking crisis, no lender of last resort, no central institution capable of injecting liquidity into a failing system. The country turned to one man. J.P. Morgan, then 70 years old, personally organized a series of private bailouts, arranged emergency credit lines between competing institutions, and stabilized the American financial system through the force of his own reputation and relationships. He had done something similar in 1895, when the federal government itself ran out of gold reserves, and Morgan quietly arranged the financing that saved it. One private citizen, rescuing the economy of the most powerful industrial nation on earth, twice. Congress understood this was not a sustainable arrangement. You cannot build a modern economy on the goodwill and longevity of one banker. So in 1908, Congress passed the Aldrich-Vreeland Act and created the National Monetary Commission to study the problem and recommend a solution. They named Senator Nelson Aldrich of Rhode Island to chair the commission. This is where you need to pay attention to the names, because the names keep appearing, and their connections to each other are not incidental, they are the story. Nelson Aldrich was not simply a powerful senator. Theodore Roosevelt called him the kingpin of the Republican Party. Progressive journalists called him the boss of the United States. He sat on the Senate Finance Committee and had shaped American tariff and monetary policy for decades. He was also the father-in-law of John D. Rockefeller Jr., whose family controlled Standard Oil and held enormous stakes in the very banks whose interests the commission was supposed to evaluate objectively. For 2 years, Aldrich and his team toured European banking capitals, studying the central bank systems of England, France, and Germany. By the fall of 1910, he had reached his conclusion. America needed a central bank, but he had no finished plan. Congress was reconvening, and the political climate had turned hostile to anything that smelled like a gift to Wall Street. So Aldrich did something that, for nearly 2 decades, he and everyone else involved denied had ever happened. On the evening of November 22, 1910, Aldrich gathered 5 men at a rail terminal in Hoboken, New Jersey. They were instructed to use first names only, to tell no one where they were going, to treat the trip as a duck hunting excursion if anyone asked. Their destination was Jekyll Island, off the coast of Georgia, a private club so exclusive that Munsey's magazine had described it as the richest, most inaccessible club in the world. Its members included the Vanderbilts, the Astors, the Morgans, and the Pulitzers. It was not a place where ordinary Americans gathered to debate public policy. Paul Warburg, a partner at the banking firm Kuhn, Loeb and Company, brought a borrowed shotgun to maintain the cover story. He had never hunted ducks in his life. A. Piatt Andrew, who had just been appointed Assistant Secretary of the Treasury, did not inform his own boss that he was leaving Washington. The others were Henry Davison, senior partner at J.P. Morgan's firm, Frank Vanderlip, president of National City Bank, with close ties to the Rockefeller banking network, and Arthur Shelton, Aldrich's private secretary. For 9 days, these 6 men worked in total seclusion, early mornings through late nights, drafts written, argued over and rewritten by lamplight. Frank Vanderlip later wrote that it was the most intensely focused period of work he had experienced in his entire career, and what they produced was a blueprint for a central banking system, a plan with 15 regional branches, a lender of last resort. A mechanism for controlling the money supply of the United States. A plan that, with modifications, would become the Federal Reserve Act of 1913. Here is what needs to be said carefully but clearly. The American banking system genuinely needed reform. The panics of 1893 and 1907 were not manufactured crises. Ordinary families lost savings they could never recover. Businesses that had operated responsibly for decades were wiped out because a distant institution they had never heard of made reckless decisions. A lender of last resort was a legitimate structural need. The question is not whether reform was necessary. The question is who designed it. While Aldrich and his associates were quietly preparing their plan, Congress was conducting an investigation that looked directly at the men doing the preparing. In 1912, the House of Representatives authorized the Pujo Committee, a subcommittee of the House Banking and Currency Committee, convened specifically to investigate what critics were calling the money trust. The lead counsel was Samuel Untermeyer, and the hearings ran from May 1912 through February 1913. What the committee found was extraordinary. The final report concluded that a small, tightly connected group of financial leaders had accumulated effective control over major American industries: manufacturing, transportation, mining, telecommunications, banking. 5 firms sat at the center of the web: J.P. Morgan and Company, Guarantee Trust, Bankers Trust, First National Bank, National City Bank. Together, these 5 institutions held 341 directorships in 112 corporations, with combined resources exceeding $22 billion. And the committee specifically named Paul Warburg among the bankers at the heart of this concentrated financial network. The same Paul Warburg who had stood in the lamplight at Jekyll Island, designing the Federal Reserve. Read that again because it deserves to land fully. The congressional investigation exposing the banking cartel that controlled American industry named, as one of its central figures, the same man who had secretly designed the central banking system, intended to address that concentration of financial power. The man identified as part of the problem was the architect of the solution. And after the Federal Reserve Act passed, President Wilson appointed Paul Warburg to the first Federal Reserve Board of Governors. The investigation and the reform were not in conflict. They were, whether by design or extraordinary coincidence, moving in the same direction. This brings us to 1913 itself, the year of 3 changes, 3 reforms presented separately, sold on separate merits, debated in separate committees and ratified on separate days, but arriving in the same 12-month window, signed by the same president, passed by the same Congress. The first arrived on February 3rd. 16th Amendment granted Congress the constitutional authority to tax income directly, without apportionment among the states, without regard to census figures. It cleared the legal obstacle that the Supreme Court had erected in 1895. The amendment had started peculiarly as a conservative gambit. In 1909, senators who opposed income taxation actually proposed it, calculating it would never survive ratification by 3/4 of the states. They were wrong. 42 of 48 states ratified it. The second arrived on April 8th. The 17th Amendment changed how United States senators were selected. Before that date, senators were appointed by state legislatures. After it, they were elected by popular vote. This has been presented, almost universally, as a straightforward expansion of democracy, and in one sense it was. Direct election is more democratic than legislative appointment. But consider what it also did. Before 1913, a senator answered to his state legislature. The legislature could recall him, pressure him, refuse to reappoint him if he drifted too far from his state's interests. This created a structural mechanism for states to check federal power. The senator was, in a specific and institutional way, the agent of his state government. After 1913, the senator answered to the voters who elected him, which meant he needed campaigns, which meant he needed donors. And in the new industrial America, the largest and most organized donors had offices on Wall Street and mailing addresses in Lower Manhattan. The structural check that states held over federal expansion was removed, quietly, in the middle of a year full of larger headlines. The third came October 3rd. The Revenue Act of 1913, also known as the Underwood Tariff Act, established the first permanent federal income tax. The rates were modest, almost deliberately reassuring. 1% on income above $3,000 for single filers, $4,000 for married couples. The top marginal rate was 7%, and it only applied to incomes above $500,000. In 1913, the average annual wage in the United States was approximately $750. The $3,000 exemption meant that fewer than 1 in 100 Americans owed a single dollar of federal income tax. This was, explicitly and emphatically, a tax on the wealthy. The Form 1040 was 4 pages long, 1 page of instructions, a document so simple that a literate adult could complete it in an afternoon. The promise was clear: the wealthy would pay, everyone else would continue as before. Remember that promise, because you need to know what happened to it. The fourth piece arrived in December, 2 days before Christmas. The Federal Reserve Act had been navigating Congress for months. There were genuine disagreements about its structure, the number of regional banks, the degree of government versus private control, the composition of the board. What is documented and acknowledged by the United States Senate's own historical records is that the Christmas holiday deadline became a significant factor in accelerating the final vote. On December 22, 1913, the House approved the conference report 298-60. On December 23, the Senate voted 43-25. 27 senators did not vote at all. According to contemporary accounts, most members of Congress had already mentally departed for the holidays. An editorial in The Nation magazine, published that week, noted specifically that the urgency to adjourn before Christmas was a primary factor in pushing the legislation to its final vote. The most consequential piece of financial legislation in American history was passed, in part, because senators wanted to catch trains home for Christmas. President Wilson signed the act at 6 o'clock that evening. He used 4 gold pens and handed one to each of the bill's chief sponsors. The Federal Reserve System was born. Now comes the part of the story that most tellings skip, not because it is obscure, not because the records are unclear, but because it is the part that reveals what the promise of 1913 was actually worth. The income tax of 1913 was 7% at the top, 1% at the base. Fewer than 1 in 100 Americans owed anything. By 1916, Congress raised the top rate to 15%. By 1917, it climbed again. By 1918, just 5 years after that 4-page form promised to touch only the wealthiest Americans, the top marginal rate stood at 77%, an 11-fold increase in 5 years, not under a different Congress, not following a different political revolution. The same basic governing coalition, the same institutional momentum, the same machinery that had passed the original tax, expanded it beyond anything the public debate of 1913 had contemplated. The exemption shrank, the taxpayer base widened. Workers who had been assured they were exempt found themselves calculating their obligations. And then in 1943, Congress passed the Current Tax Payment Act. Before 1943, if you owed income tax, you calculated your liability at the end of the year and paid it yourself. You saw the money, you held it, you chose to remit it. The transaction between you and the federal government was visible and deliberate. After 1943, your employer deducted the estimated tax before your paycheck was printed. The money left your wages before it ever reached your hand. You received what remained after the federal calculation. The government's share moved first. Yours came after. This arrangement was sold during World War II as a wartime efficiency measure. It has never been reversed. Think about the architecture that was assembled across 30 years. The 16th Amendment created the legal authority to tax income. The Revenue Act created the mechanism. The rate increases validated the expansion. The withholding system automated the extraction. By 1943, the system designed in 1913 had become invisible. It operated before you woke up, before you reached the bank, before you had any practical opportunity to experience the money as fully yours. It simply arrived already lighter. What you now have is a complete picture, or as complete as the documented record allows. 6 men met in secret on a private island in November of 1910 and designed the central banking system of the United States. They denied the meeting happened for 20 years. The Federal Reserve's own historians have since confirmed it. The congressional investigation that documented the concentrated financial power of Wall Street named one of those 6 men as a central figure in that concentration. That same man was appointed to the first Federal Reserve Board. 3 constitutional and legislative changes arrived in the same 12-month window, presented as separate reforms but structurally interdependent. The income tax created a scalable revenue mechanism. The change in Senate elections removed a structural check on federal expansion. The Federal Reserve placed monetary policy under a system designed by private bankers operating behind a governmental framework. And the promise that was made explicitly and repeatedly to the American public, that this income tax would touch fewer than 1 in 100 Americans and would remain a tax on great wealth, was broken within 5 years. Not gradually, not reluctantly, 11-fold in 5 years. I have spent time with these documents. I have looked for the holes because I wanted to find them. I wanted the Jekyll Island meeting to be a myth. I wanted the Pujo Committee connections to be coincidental. I wanted the rate expansion to have some clean, inevitable explanation that had nothing to do with the original design. The documents did not cooperate. Every time I reached for a debunking, I found a confirmation instead. The Jekyll Island meeting is in the Federal Reserve's own institutional history. The Pujo Committee report is in the Congressional Record. Paul Warburg's name appears on both lists. The rate table from 1913 to 1918 is in IIS archives. None of this requires inference. None of it depends on a single source with an agenda. It is the settled, verified, publicly available historical record. Here is what I want you to think about. Your great-grandparents entered 1913 in a country where the federal government had not taxed personal income in 41 years, where a worker's wages belonged entirely to that worker, where the Treasury funded itself through tariffs and vice taxes and never reached into the paycheck of a laboring man or woman. In 12 months, that changed. Within 5 years, the tax that was introduced as a modest levy on great wealth had expanded 11 times. Within 30 years, the money was taken before workers ever held it. Within a generation, income tax replaced tariffs as the largest source of federal revenue. Today it generates more than $1.5 trillion annually. 4 pages became thousands. 1% became 37 at the top, with brackets touching middle incomes decades before anyone in 1913 would have considered them wealthy. A tax described as touching fewer than 1 in 100 Americans became a deduction from virtually every working person's first paycheck. The buildings that housed those 1913 debates still stand. The legislation is still in force. The withholding that began as a wartime emergency in 1943 has been collected every pay period for over 80 years. And the men who designed the core of this system, they knew each other. They met in private. They used assumed names. They brought borrowed props to maintain cover stories. And when the investigation that was supposed to hold financial power accountable produced its findings, the man it named helped draft the reform. I am not telling you what conclusion to draw. I am not asking you to decide whether this was conspiracy or coincidence, captured reform or genuine institutional evolution. I am not qualified to resolve questions that professional historians still debate. What I am asking is simpler than that. I am asking whether you knew, whether anyone told you that the income tax of 1913 came with an explicit promise that it would remain a tax on the wealthy, whether you were taught in any classroom that the man named in the money trust investigation designed the central bank meant to break it up, whether you were ever shown the rate table, the 11-fold expansion, the 5 years. Because here is what I know with certainty. The documents are public, the dates are verified, the names are on the record, the meeting happened, the promise was made, the promise broke. Every 2 weeks before you touch your paycheck, the architecture built in 1913 and automated in 1943 processes its calculation. The number arrives already reduced. You receive what remains after the system designed by 6 men on a private island in November of 1910 has taken its portion. Your great-grandparents saw the first Form 1040, 4 pages, 1 page of instructions. A quiet guarantee that this would only ever touch the powerful. If they could see the form today, and then look at your pay stub, the only question worth asking is whether they would be surprised, or whether, somewhere in the fine print of that first 4-page document, they already suspected what a promise made in December looked like by the time spring arrived. The Jekyll Island meeting is confirmed by the Federal Reserve Bank of Atlanta's own institutional history. The Pujo Committee report is in the Congressional Record, 62nd Congress. Paul Warburg's dual appearance on the Pujo findings, and the first Federal Reserve Board is documented in official Senate and Federal Reserve records. Income tax rate history is available through IRS statistics of income archives.